Do you think we would have seen this market reaction of yields on the front end up 11 basis points, the strength in the dollar you're talking about, small caps up some 2%, by all accounts a large market reaction? Do you think it would have been different if it wasn't August, if it wasn't the middle of the summer, and we were all back at our trading desks?
I think it would be. We are now back to good news is good news, and in our view, and we're moving out of that really conundrum type market responses we used to get, where it'd be like, okay, this is bad news, but now all of a sudden rates are lower. That's helping small caps. Good news is good news again for growth. For an asset allocator, that's great news. It's been really messy from a macro standpoint because you get a long-dated treasury rally and small cap financials doing well. That is a weird asset allocation mix. But now we're seeing that basically longer-dated yields coming down is not necessarily good for growth. We're seeing defensive equities. You look at the guts of the market, it's defensive equities that are doing well. And so, I think it's actually good from an asset, I guess from our perspective, is that it makes sense. It's logical. And for investors, I think that's a good thing because for their portfolios, that also makes a lot more sense.
Well, one of the things that people had cheered last week for their portfolios is finally bonds can act as a hedge, that the correlation is broken. You do see the correlation this morning of stocks up, bond prices down. But Matt, if we're not in an environment of a recession and we're not worried about growth necessarily, does that interplay hold?
We think it does. And frankly, the Fed, you've had a lot of guests on this morning, and we're hearing all these cut talks. And it's just, for us, it's overly optimistic, looking for 50 basis points per meeting through the end of the year, and really looking for 100 basis points in cuts. We actually would underestimate that, look for less cuts in the short term, more cuts into 2025. Now, we're not trying to get cute with this. The bond market's going to see some volatility around this. We would still embrace intermediate, higher quality bonds for 2025, where we think we're going to get more returns out of it. But for now, just get the income. We're still going to get about a half of 2.5% in income to the end of the year. Just be careful, just be happy with that. And then we're going to likely get more returns. But for the meantime, we actually think the dollar gets a nice bounce here. We think that some of this rotation out of the dollar is overdone. And so that's what we look at tactically in the short term.
Well, Matt, at the moment, it looks like the market agrees with you, and it's not trying to be, in your words, too cute, with Fed swaps pricing in less than 100 basis points now after this data for 2024. So what are you expecting in terms of the totality of cuts for this year?
And I think three, even a quarter basis point per meeting, and even maybe just a quarter basis point, a quarter of a percent, 0.25, and then maybe even another one. We skip maybe even November and go to December. Look, it's the beginning of the cutting cycle. Either way you want to put it, that's going to be bullish for bonds over time. But we don't think that right now the economy is screaming for the rate cuts. We've had people come on asking for a 75 basis point cut on the back of not even a 10% correction in the S&P. We think that's overblown. So just be patient. We don't want to, let the politics get in the noise. And look, if you get another opportunity to embrace bonds as yields back up, we would take it. We actually want that right now for our investors as we set up for 2025.